You know, Shan, I heard some on the network earlier suggest that we were 0 for 2 this week in terms of NVIDIA and the Fed chair. Not that NVIDIA didn't knock the cover off the ball, but the reaction didn't exactly suggest that the report, was something to really build on because the stock had already done a lot. And then when the market was down earlier, it was like, well, Powell was more hawkish than we thought. When the reality is, if you now have the ability to step back and look what happened this week, NVIDIA did knock the cover off the ball, didn't do anything to upset the story there. And Powell maybe wasn't as hawkish as some actually feared. And we have something at least we can take away that wasn't horrible.
Well, how could you not fear Powell's address here at Jackson Hole, given what we experienced last year, Scott? I think those of us are scarred still from that a year later. I think one of the things to think about is that you're right. We didn't get as hawkish, perhaps, a statement from Powell as we might have expected. And to the professor's point, we also didn't hear some of the things that I would have anticipated hearing. I know the professor, would have liked to hear more about productivity. I would have liked him to acknowledge the fact that we're seeing a reacceleration in food and energy prices, because frankly, although that isn't in core, that's an important component of consumer spending. And the consumer is clearly continuing to drive the strength in the U.S. economy. If you look at what happened this week in terms of what the Fed expectations are, we're really looking at a period now over the next 4 weeks or so where the market is going to be very much focused on economic data, data dependency, and what happens next. And Scott, to your point, we're down to we incrementally up to about 20% chance of a Fed hike in September, about 50% in November. I would counter that those aren't nearly as important as understanding what the policy in 24 is going to look like. And what we saw after the meeting today was we saw that the expectations for rate cuts in the second half of next year came down after the meeting today. And I think that's an important piece. What does higher for longer mean? How does that get priced into equities and the multiples that we're paying for stocks today? That's really where the narrative is going to start to shift. I think we're past either September or November and really looking into 24 now for policy.
Christine Lagarde, the ECB president, do we care about at this point what other central banks are doing and what other central bankers are saying? She says ECB to set rates as high as necessary for inflation. Okay, they'll do whatever they have to do, I guess, to keep inflation under control. Do we care as investors here?
Yeah, I think we need to care, Scott. I mean, I think we need to care as it obviously affects yields here in the United States based on, kind of relative yields and what's available. There's been significant movement in the currency market. We have the Bank of Japan really engaged, if you will, from a currency perspective in a way that they really haven't ever been. And so there's a lot of policy questions there. I think most importantly, though, is just trying to determine, where's that tipping point? Where's that inflection point where valuations are so high here in the United States that regardless of kind of incrementally tougher conditions in a place like Europe, when do you make that choice to increase your allocations there? And certainly as it relates to the strength or relative weakness of the dollar. And so all of these things, we have to understand that we're entering into a period, Scott, where we're not going to see as much sort of collusion, if you will, in the nicest way of saying it, between central banks. We're going to start to see divergence in policy. And that has a lot of implications if you're allocating, whether it's in the United States or outside of the United States, and also between equities and credit.